130, we're looking for 133, okay, the strike. They don't even have 133. Let's choose 130, so $7.95. Let me go back, choose the same strike. But you know, before we have 125, let's choose 125. So if you choose June, this year, you will pay $11.23 for this strike, 125 strike, okay? So if we go back, I still choose 125 strike, go back, what do we have tomorrow this week of expiration day. All right, let's go back, okay, 125, here, 125, okay? Hold on, what I choose? April, I say 23, okay, so, all right, 125, okay, so $8.10. Before it's $11, right? So showing you what? Same strike, okay? And it's the same stock, right? Everything's the same, but different maturity. It have different value. So in this case, same strike, the longer one, so this one, it is April, which is this Friday. But if you choose June, that one, what I choose, then you will be more expensive. The time value there, okay? So let's go back again. See this longer now, 125. See you pay $11.20. That means even the same strike, same stock, right? It's option, but then you pay more because longer time, couple of months more. So that's what you can see. They will give you some idea about those options and have time value there, okay? So let's go back to the normal way. So option last time I showed you the graphing about say how you long and the call. You always have the other guy, right? Always have you long the option. Somebody must be there selling, or your broker or your dealer. Somebody must trade with you can finish, all right? So that's what I mentioned about this. Option have right because you pay, that's why you have right to it, and have the exercise price or call strike price. Either way, that's what it is, right? Refer to. And I showing you the expiration, you know, always have expiration that you refer to, okay? Also call the term to expired, all right? So you have always seller. So your buyer is have right to do something, but seller, you don't have right, but you have obligation, means you have to. If somebody buy, they say, your broker say you have to, you know, selling, you have to sell, so they will be assign you. So that's why at the end, somebody asked me about the wheel strategy. Wheel strategy is playing, that's why I call it wheel, right? So you are selling the put, and then your market against you, all right? Market against you, then you are getting assigned the share. Remember, your selling put is the other guy have right to sell. You don't have. You're selling the put, you don't have right to sell. You have obligation. When they're selling to you, you have to have the share. They assign you the share, means you have to buy the share, okay? So when you have that's called assigning your share. Once you get a share, so you selling put, you get a premium, right? I mean, just because the option cannot just verbal talking, you have to see it, right? Let's do one more time about the options. You're selling the put, okay? So this is the stock go to this direction, but your selling put is like this. So put is supposed buy put, the other guy buy put, right? So you selling the put. So this is the put profit. You long the put. You start going down, you make money, okay? So now you did it is you're selling the put. You do that. So you're selling the put. So money, this long. Who buy the put, the money paid give to you, put it in your account, but you cannot touch it until to expiration day. You did this one, okay? You're selling the put. So your profit provide like this one, okay? So if the stock going down, what happened? You assign the share because you're selling. The other guy exercise. It means the other guy have right to selling. They're selling. They're selling and give to you the share because you short it, okay? So you short the put. So then you got a share. And then what happened? You have the share right now. Immediately selling the call. Immediately selling the call right now. Once you got a share. That's what the wheel strategy. Okay? So that's what you're just betting on. So already got a share. You have share, you don't mind to call you because you already have a share. If call you means call your share out, you have the share and give away. So that means you at least have these two premium, 1 and the 2, and that's what a wheel because it's rolling, okay, keep rolling, they're turning like a wheel, okay, so you understand that. So that's what I mean is, but you can build up many strategy, not just have the based on what their strategy is. So like I say, you have so many lag, right? Have the up 4 options, right? Can call, long call, selling call, long put, selling put. Then you can build up all kind of strategy, okay? Like I showed you last couple of times, butterflies, and you can do the straddles many ways, okay? But they don't need to based on this name, based on what we are not option classes. If when you go to advanced class, when you're senior, you can go to, they have the derivative class, talk all kind of derivatives, okay? So then how exactly calculated the option trading, okay? So here to give some idea about this basic idea. I mentioned about the break-even point, the option break-even, long call, long put, selling call, selling put, those break-even point, we did it and you get it right, remember? So without those one basic things you need to know, all right? And the other thing is, remember seller have obligation. So if you, let's go back again, if you are not long, you're selling, you get trouble. Another trouble is like, I have to mention this one, okay? So if this is stock option go this direction, right? So let's say you long the call. This is a very common situation, right? You long the call. Okay, normally people are very smart. They will be exercise the call before the dividend day. Okay, so they buy the before dividend day, and then let's say tomorrow going to be dividend day. So that's called ex dividend. So people exercise today because I have a call option, so I can exercise today. Then tomorrow I collect dividend, right? So that's person calculated very well. But if you do the selling, you do the selling call, okay? And then this guy did the exercise, then you have obligation, remember? So you have to, this guy exercise, get a share. So you said in the call, so you have to give the share to this person. Remember, this person exercise next day, get a dividend because they get a share. And you have to give the dividend. All right, let me tell you again. So that means the seller selling the options, you have to responsible the dividend. So that's why the other guy who long the share get the dividend is from you, from the short seller, because they got the share, you don't, so you're selling it, so you're responsible. So you have to be careful there, because if not, you got a double lose. Shares gone, dividends gone too, okay? Dividends definitely won't give to you. Remember, seller of the option don't have a dividend, okay? So that's another couple of things to tell you here. All right, so buyer does not have to exercise. You have right to exercise. But if stock moving in the direction not favor to you, against you, you don't have to exercise. It means just like I say, just go to the Broadway show, don't go, and that's it. But the worst case is just a tickets for Broadway show, that price you pay, and then you know the price. So not terrible wrong. But if your market against you, that's terrible wrong. That means you cannot control. But this tickets you can control just the option value, option the premium price you pay. You already know that moment. So that's why it's not a big deal. All right. So that's options, and we mentioned about those already. So I said that option premium is option price. The least there just saw it. You just saw that one. Okay. So that's the word of the option. You need to buy, you need to pay to buy the option. Otherwise you don't. Okay. Now here mentioned the American option and European option. I mentioned it before. American option means you can exercise the option what you have it anytime you want to. Because once the market favor to you, you say, I don't want waiting for another day, maybe another day the market is going back. So then you just exercise now, so which is good. But if a European option means you have to waiting for, no matter what happened, you have to waiting for expiration day, and you're going to be expired, automatically get a result. So it doesn't matter you make money or do not make money, but you have to hold on until to maturity day. Okay. That's why European option is not that great as the American option. Okay, American options such valuable, right? Because if a market like this couple of days earnings season, if the stock doing so well, like today IBM doing good, if you feel good enough, I'm out. So then you just cash out, exercise the option out. Even now, let's say Friday expiration day, there are tax on any gain. Yes, any gain, like your options, it is called, if you exercise, let's say if you do that like within this year, it's called capital gain, you will pay tax. You know, dividend is called income tax, dividend tax, the income tax. But the option, when you exercise, make money, that's called capital gain. And you overall in your portfolio, you capital gain, then you pay capital gain tax a year. Yes, you pay. Okay, so European and American. So now you know the difference. So which stock is more expensive compare, if same, everything else the same, just compare the American option versus the European option, which one price a little bit expensive?
American options.
Yes, American options. Yes, very good. All right, because that always like that one. If they give you so many good things, they pricing in. So that means American option expensive because even same thing, same Apple, same strike, same maturity. But if this option is American option, it will be a little bit pricey because you can early exercise. Okay, yeah, that's good. So stock option, future option, very, very powerful. Like I just give you your couple, like build up those strategy. Option can on top on future. Imagine you have a future, right? We just learned as the future market, that bond, the treasury bond, we can do 1 month, 1 year future, remember? But option can on the future. Option can on the derivative, like a swap. We know swap, but can call swaption, means option on top of the swap. Can you believe it? Derivative, it is underlying have assets. Then you on top is derivative. Now option on top of the derivative, so that means 3 layers, right? So that means you have future options. So that's more complicated, become couple variables underneath moving around, then option control that. Okay, so option on top of a derivative, many ways. But so like I said, once you learn the advanced class, you will touch those advanced level of complicated options, right? So now you just know, have those way. Okay, so option, like I say, is very complicated. So then you have market there, regulation is always there. But however, like I said, the future market, option market, the derivative market, they handle pretty good so far because they have those margin requirement regulation. They did a good job on that piece. Okay, so that's the market. So contracts, like we did already, right? Just option, you have a call. So if in your broker account, you will see call option, you have, you have 4 legs, long the call, selling call, and long the put, selling the put. So you have more ways. You selling the put is not selling the put, is short, right? So that means open the position. You're selling put, open the position. Remember, if you have put, you're selling, that means close the position. All right, it's different story. So now you have this all kind of opportunity, long the call and the put option give you right to sell. Okay, remember you saw the chart to sell. The call is give you right to buy. You have right because you have that tickets. Remember, you pay the premium. That's why you have this opportunity to do what you want because you pay it. All right. The same thing put is you have right to sell. Remember last time I was showing you, no matter how going down the stocks, but you still can set, you have right to sell it at a higher price at the strike you choose. So that's why. Okay. So we did those. Yeah.
I just want to ask real quick about, so for the options contract, you mentioned that the buyer has the right to choose.
Yeah.
So what if it's in a put situation where the owner has the right to sell? How does that work with a contract where the buyer has the right, not the owner?
Yeah, you put your buyer, same thing. Let me show you that the Yahoo Finance here. Okay. So I show you call this piece. Okay. See, here's the call. This is the call. Okay. So that's going down the put. Okay. Have you seen put here? Put okay, very good. So that choose closer. Don't go crazy, right? Choose closer right now. Trading at 130. Okay, see here. So let's say you choose this strike, the put. So you have right to sell. So right now, today, this is the expiration date on June. Okay, so you have 2 months away. So today, if you buy the put at this strike, you pay $5. Okay. So what are you betting on? You pay $5, you have luxury is if you betting on this Apple from now going forward, going down by June. Okay, so this is 2 months period. You betting on going downward, going to this direction. So then you pay $5. You're waiting for from now to June, which is 2 months. Stock could be going this way. For example, stock going touch 120, but you still have right to selling at 130 because you have put option. You have put option means right to sell. So even go to tumble, go to 100, you still have right to sell at 130. That's why when market tank, you have put is good things because you have right to selling. So you hedge it. That's why I hedge it, right? So imagine if you go to $100 before the June, and then you're still selling 130. Okay, so you're selling at the market, then you're selling 130, and then market is 110, 100. So you make $30. Okay, and then you pay $5 minus $5. You have so really net result make it $25 per share, and multiply 100. So you know what? So 2,100.
But isn't it the buyer who has the right to exercise this?
You bought the put, right? Yeah, you bought a put. So you have right to selling at 130. You bought a put, right? So that's why you have right to selling at this one. The other guy who is selling the put at this strike, he have to facing this consequence because you have right selling 130, market trading 110. So you definitely will selling this guy at 130. This guy will get your share. He had to pay you 130, but you do not know. The other guy do not know either because this is the market handle both of you. You just if you're short, the other you're short. You in your market in your book in your account, you will see the broker right take out your share, and also you're gonna pay at 130 because even the market is trading 110, 100. Because the other guy have right to do it. You don't have right because it's selling the put. So selling means you're short the call, short the put. You have to be careful about this movement because it's going to be against you. Okay, and plus you had to put a margin in the account, margin requirement. You sell it. But for you long the call, down the put, you don't need to put a margin because you don't have risk to broker. But a short selling have the risk to broker. That's why they wanted your margin. Okay. So that's why you always figure out the other guy, the other side, what could it be. If you take the other side's direction, you got to know what your risk is. All right. So that's a call as a put. And next one is just tell you if compared to the future, right? You can see if the blue one is you buy share, you only buy share. Okay. Then you will profit will be look like the blue this line. Okay, means if this asset is going upward, for example, if this stock going this upward, then you will be going up, make money, or going below 115, you're going to lose money, so you're negative. All right, so you buy the share, you profile just like this. You know, going up, you buy at a 115 that moment price, and then it's going upward, make money. Going downward, you lose money. Okay. But if you didn't do that, you buy the call option. You didn't buy the future, buy the underlying. Okay, you buy call option. You can see call option. You buy this. So break even, for example, is here. The interception here, and then if after that stock continue going up before expiration, okay, then you will definitely make money. But if a stock going downward, you don't lose money. You just lose the money, you pay the premium. This the money costs you pay the premium. And you know it, you pay it. You pay the negative one. That's why I said break even. And after that, you cover your cost. But however, you can see the longer the better because let's say just about starting to make money expired. then you didn't make money, okay? So longer the call, the better. So means because eventually will moving upward, then you will make money. But if not, the worst case you just pay the premium. But the longer you saw the premium price, the longer the more expensive. All right, because time value there. All right. So same thing again. You're selling. If you're selling, you see, if you short this security, let's say the stock or future, the stock going down, you can see you make money because you're short, okay? But if you're going upward, you lose money, okay? But if you long the put, remember you have right to sell. So that means if going downward, it's okay. I can still, in this case, you have right selling at 115. Even going down, you still have selling at 115, okay? But if upward, you don't lose anything. You just pay the premium. Not like this blue line, you lose money, okay? If you're going upward, you lose money because you're short. But this one do not. That's why options is good protection. But the only thing is cost you. You had to buy long call, long call, long put. You had to charge you for pay the premium. All right. So that's what tell you the difference options versus the future contract. Okay. So difference between options and future contract. So you can see the key difference. One is, future don't cost you. Future you just get in the contract. That's it. You don't need to pay. So that's why you don't need to have to cost you $2 per share to get in this option. All right. So then that means basically free, right? Like getting in this future contract is free. You free the contract, but at the end, the material you have to deliver or you have to close contract. So you totally use the future for hedging. Option you can play, you can pay premium, you can play the premium, right? Like I don't bet any direction. I just want a premium. You can try to build a strategy, get somebody else long, cost that money, put it in your pocket. You can play that too. That's why option much more popular because people not just for hedging purpose, more people for make a profit from the option premium, right? From somebody else's money. That's what they do. Derivative, that's what they're trading. That's really trading. Okay, that's play. Okay, so future. So for a future contract, the profit grow by equal dollar amount for every point increase in the underlying assets. Just like we have the future of that treasury bond, 30-year maturity, whatever, we did that treasury. So that's a treasury bond. And then they can list this treasury bond as a future too. That's why we hedge it on 1 year, because the 1-to-1, the future contract just refer to that maturity treasury bond as underlying assets. That's it. And then that's why I give you opportunity to hedging. All right. So that's what I'm trying to tell you. Future contracts is exactly point to underlying assets, point-to-point movement. Okay. Just like this one, okay? For this one future contract, your movement just like underlying assets movement, going down, going loose, going up, same thing like what we did. That's the treasury bond security. That's why we can hedge it, right? Because they movement like that way. So that's one thing. So for option contract profit, do not, right? You saw that the options, you cannot go, you don't lose money on the bottom here. You don't lose money here. So protect the downside risk, all right? So that's what's different. So options contract profits do not always grow by the same amount for a given change in price, right? Over the underlying financial instrument because of the protection, like we just see the flat line, okay? So that's why it's different. It's not 1-to-1 because you have here, you don't lose because protected, all right? So that's a good one. That's why it's different, right? But you pay the price for that. Okay, so initial investment on the contract's different, right? Because the option you have to pay, or you short, you get a premium, but you cannot use it, okay? Another thing you need to mention that, remember your long the call, I shorted the call. So your long the call pay $2 per share will give to me, but I cannot touch it until to expiration day. Otherwise, everybody short and say, let's say I shorted 1,000 shares and I make a lot of money in my account. take out or go buy a house. You can't. All right. You had to be stay there until to expiration day. Plus, you had to put a margin. Then, if expiration day nothing happened, you're so happy because your 1,000 shares all in is safe. So that's the situation. Okay. But otherwise, you cannot do it. You cannot use it. Okay. So money changes hands daily in the future market. Okay. Because they mark to market. So only once for the option contract. You see the difference? Because future market, mark to market. So the margin called daily, daily will be calculated based on your situation or position. Option based on your exercise, you can early exercise, but the exercise at moment, you cash in. All right. So otherwise, it's just paper on paper. You make a lot of money on paper. Remember, that's why you have American option. You can early exercise. You have realization gain. Otherwise, on paper. But tomorrow, market turning around, you all faint. You make money all faint. It's gone. It means like very quickly disappear. The option very fast. Okay. So that's the difference. All right. So next one, pricing. Option, like I said, so that's the option premium, right? But you did see this direction. You can see higher the strike price, while everything else being equal, the lower premium on call. What I mean, okay, see, because the strike, so you can base on this, let's see where you can base on the chart, okay? So let's see that we talk about call. Forget this the shorting, okay? Let's do this one, okay? So what you're trying to say is because you have here's a strike, this is a strike, okay? So this is strike. So what you're trying to say, if you buy the stock, the strike is here, right? If you buy here or you buy here, because that's will be buy here is cheaper, buy here expensive because you buy deeper in the money, right? So this one is if it strikes here, so you can choose either way. This is the add money moment. Then you buy out this called out of money because you do not even know they're going to move that far. But the stock definitely right now it is in this way is in the money. So that's why if you buy in the money, very expensive. But if you buy higher, let's say Apple stock right now trading at 132, for example, today. Okay, that's a 132. Trading at. But if you buy at a 133, that's called out of money. But let's say it's so cheap, very cheap. You go looking at it, we'll show you a version, okay? You buy here in the money, so then it will be expensive. Let's say buy here will be 120 in the money. Right now it's trading at a 132, and you are 120. That's you pay a lot of, you pay dearly, right? So let's see the Yahoo Finance give you some idea. So what are you trying to say? See, let's go call. Call is here. All right. So you can see right now, let me show you. So right now, 133, right? If you 133, let's choose a little bit comfortable location. Okay, see the deeper, go back. So if it's 130, strike $8, but going all the way down, 120 expensive. Okay, 150, because this is way in the money. What do you mean in the money? It means the stock price higher than strike price for call option. In this case, much higher. Okay, so right now trading 133, but you want to buy at 115. It's in the money. Means sure the stock already. You're already sure this stock pretty much very deeply in the money now. Means you will make money. But however, if time too long, let's say this will be 2 months, but then within 2 months, this stock keep going drip down, then you lose $18.96 because eventually go down to 115, means all you in the money value wash out. But looking at if you buy out of money, okay, that's like, see, this 72 cents, very cheap. But then this June, if you believe from now to June, the stock will be fly and you just pay 72 cents. So what do they just say like this, okay? Depend on call and put. So that's how this expensive, not expensive, depend on where it is, you choose. Okay, see, higher strike price, we just choose it. Depending on the call, so if it's call, so higher strike price, everything else being equal, lower premium, just saw 72 cents that one for call, okay? For put is reverse, okay? So you just choose one, you will understand another one. So it's going to be cheaper for you. So depend on you. You want to buy expensive one, you want to buy a cheaper one. Cheaper one, your guessing stock will go to 160 that level, but you only pay 72 cents, you know? So maybe you never touch that level. It just was the 72 cents, okay? So this will give you some idea. So the greater the term to expiration date, I just shown you that, right? The longer one, more expensive. Everything else being equal, the higher premium for both the call and so that's why option, both put and call option, as long as your expiration date longer, time value there, so will be expensive. Even same strike, but the longer, like if you choose next year, that's called leap options. No matter which strike, they all compared to current strike will be expensive because it's longer, more expensive, okay? The other one is very, very important. You heard about people talk about volatility, okay? Options like a volatility. Volatility high is the best for options, okay? So greater the volatility of the price of the option underlying price, right? So let's say Apple stock is very volatile. It's good to buy option that way, okay? So greater the volatility of the price of this underlying security, okay? So for example, it's Apple, everything else being equal, the higher premium. So therefore, during the earnings season, you saw the options expensive. Okay, at that moment, actually, it's good time to option expensive. Actually, it's a good thing for good, very worth it to selling the premium, right? Because after earning, then it will quiet down. Then volatility is lower. They won't have a swing movement. So you're selling options is a good deal. So that's why, but however, you take a risk, remember? So that's why options volatility is a positive for options. Volatility higher is a great thing to do, okay? Because they can, moving to the target very soon. So that's a good thing for you. But if you're selling the call, selling the put, right? At the higher moment, selling volatility high, premium high. So that's why it's a good deal. But if it's selling at a quiet moment, the lower volatility moment, you anticipate it going upward of the volatility, you're selling the call or put will hurt you more. Okay, so that's you can see that way. Okay, so we done the options. Okay, like I said, options is very, very popular. A lot of strategy, a lot of stories. You like somebody mentioned about us. You have a delta, gamma, vega. Those measure those sensitivities. So you go to the one class. You're gonna do this options deeply. Okay, so let's go next level. Swap. For banking, swap is very, very popular. If you're working at the financial industries, I think you have no way out. You're going to touch swap, okay? Because swap is interest rate swap, credit default swap, currency swap, many swap they can do because banking needed those one, okay? So here, financial is a contract, okay? So that obligate each party. Normally swap just like, let's say Bank of America swap with Citigroup. They just make an agreement, right? They do it to each other's. So they negotiate about, that's why they have counterparty. Counterparty, you can manage your counterparty risk. Because once you do the swap, counterparty, you have group of counterparty, they could be have any problem. For example, if you're in JP Morgan, your company have counterparty risk with many swaps. So you're going to monitor those counterparty, what they're doing. If they are financial not good, then you have counterparty risk. You have to make sure you protect yourself, right? So that's what it is. Each party in the contract, you have to follow this agreement to see whether they are doing a good job. So that's the swaps, okay? Depend on the instrument, depend on what. If it's currency, it's currency swap. If interest rate, interest swap, it's a credit default swap, it's credit under the agreement, that's this credit swap, okay? So currency is relatively easy because because banking need a different currency. If you're dealing with Europe, a lot of business you're banking, so obviously you need a euro, right? You are dealing with Japanese business a lot, so you have many Japanese customer. You need a yuan, so many currencies. So you need to do the swap, so then you have convenience to do business for small and big business settle on those currency. So banking do a lot of those currency swap. All right. The other one is interest rate swap. So let me give you some idea about interest rate swap or any swap of the chart. Very easy. Just some idea about the swap. So underlying can be different things, but swap normally is two party. All right. So this is party one, party A, say, and then you have another party. Party B, right? So Goldman Sachs was the JP Morgan, for example. This is swap. So you give me something, I give you something, but day one, at day one, there's two, whatever refer to assets. For example, if interest rate swap, party A say, oh, I pay you 5% interest rate or coupon rate for this period. For example, if 5 years maturity, hypothetical, okay, just say 5 years mature. Okay, and I give you definitely 5% each year and every year. Definitely refer to which assets or what. Let's just say refer to just $100 million. All right, 5 years, and then party A pay 5% of 100 million, which is 5 million a year for 5 years. Okay, and the party B will say, okay, I pay you LIBOR. We mentioned about LIBOR, right? So just you not use now LIBOR plus let's say 1%. Okay, so party B paying you floating. That means party A need a floating rate, right? So they want the LIBOR. So day one, today, when you and me, party A, party B, get in this contract, that moment, they must be equal. They must be equal to zero. So it means I don't make money, you don't make money. We both do not make money at day one. So they must be equal. So that moment at day one, LIBOR equal to what? Equal to what? At day one. At today, when we get in this contract, what's LIBOR? I think
4%.
Yes, thank you very much, Joe. Okay, 4%. Okay, so at day one, when we get in that moment, must be 4%. So today equal to 5.5. So both sides happy. Both sides is in the zero. Means nobody have anything to arbitrage, right? So we're good. So then, what happened is party A believe what? So party A betting on what? Party B betting on what? Choose your position. Let's say you choose yourself as a party A. If you enter this interest rate swap, you know, one leg for floating, like a fixed one for floating. If you are party A, what are you betting on? Oh, I give a hint. What do you believe LIBOR going to be from now going forward 5 years? Party
And it would go up?
Yes, very good. Yes, that's what the party A betting on. Okay, so party A will believe from now going forward will be within the 5 interest rate will going up, LIBOR will be more than 4%. That's what the party A believe on. But the party B is not. Okay, party B believe, party B paid LIBOR plus, party B will believe not. Okay, LIBOR will be not above this 4%, will be lower than that. Okay, in general like that. But most times the banking have too many lags to net out. So sometimes banking hedging it. They have to, like a party B, maybe they know they're gonna lose from LIBOR, but they have another leg with different party just want to cancel out, so they have to do that. So that lot of purpose you do not know. If it's just simple this tree, obviously party A, party B betting on the things differently. But however, party B could be have another leg with the other party. That's why they have passing through the LIBOR. Maybe they do that. Many you do not know because sometimes banking have very synthetic complex for the trade. Okay. Very good. That's what I mean. Okay, that's what it is. The swap, like I just used the interest rate swap, fixed leg versus floating leg, and you can use the currency too. Okay, so that's a swap. Okay, so interest rate swap, I just showing that that's one is. Okay, so you have to be tell each other, you two party, right? very specific. Like I just mentioned, I use floating, you choose LIBOR, they can choose treasury, they can choose something else. Okay, very clear, choose which one, amount, maturity date. So all I choose it. So that's why I tell you, very clear about this information. So amount is notional amount based on that calculation. So that's why you can see, another thing is people make a mistake regarding to during the financial crisis, say, oh, we have trillions swap in the market. But you can see this 100 million is called calculation or notional amount. Because what? Because you can see, if you say 5% multiplied 100 million, party A pay party B, end of year pay 5 million to party B, right? But the party A will be, party A pay party B 5 million. But party B pay party A is LIBOR plus 1. Let's say end of year LIBOR is 3%. Let's say 3%. Okay. So party B will pay 4% total. So 4% multiply 100 million, so which is 4 million. So net result is 5 million minus 4 million, only 1 million changing hands. Okay. So that means this really is just calculation amount, or called notional amount. It's not true value. It's just used as this is true value, net result, market changing hands value. So therefore, that moment when they quote, we have $1 trillion in the market of a swap, but that's wrong. They based on this, but really this based on should be net value is, that's really market, both sides involved deal. Okay, so that's why here trying to mention is notional amount, notional principle. Okay, currency on the other hand, currency swap different, because remember we just mentioned currency. Two banks, when they want a currency, they really want a currency. I want a dollar, you want a euro. We have to swap right away because you use that, and then based on that calculate the exchange rate, whatever, so many information there depending on your agreement. But you need a currency. Okay, that's why that's different story. Then this one needed to pay the currency right away, now now called notional amount. So now notional amount is used for calculation, also called calculation amount. So net result really just $1 million changing hands, floating around for a while. It's now really $100 million. Okay, so that's the thing. So time period, we said as the over the exchange continues, right? Just like I mentioned, the time period expirations. This is good. This is a good example. This is a very good job actually to drawing this chart. See one party. So Midwest saving banks. Okay, and it's another banking friendly finance company. Okay. So what do they want to do? They want to do the interest rate swap. Like I said, banking do swap a lot. Okay. So this banking, Midwest saving bank, they pay this way. They pay fixed rate, say fixed rate over 10-year period. So every year pay this much. So 5% multiply 1 million. So that's net result each year paying until to 10 years over. Okay. But this one is a friendly finance company paying is a floating T-bill. Remember T-bill? T-bill is every, depending on, let's say 3 months T-bill. Every 3 months, they auction the new T-bill. So that means the new level of interest rate. So that's interest will changing, right? So in our case, let's say from now going forward, we do know interest rate going higher. So every 3 months, this fuel price, interest rate will going up. So then this bank and this friendly finance company will pay a little higher and higher if this is going to happen. But over 10 years, this agreement, within 10 years, you had to be follow this until to expire. So that's the interest rate. But banking, forever. I remember one colleague, she take care of those swaps and the bond security. It's like 75 maturity years, 100-year maturity. She says, I died, the bond is still going on. Yeah, that's true. Okay, especially European, British had the 100-year maturity bond. So then if you take care of those kind of contract, you just forever, even you died, they are still there, keep going on. So that's why this swaps can continue going on even without you. They are still contracts very, very long term. Okay. Another one tell you advantage of interest rate swap. Okay. Remember I mentioned about normally is doing this is banking or financial institutions, right? Because they needed this instrument. That's what they do. That's if a banking like JP Morgan doing those millions, billions, it's very, very large. Okay. So large transaction comes from a rearranging, right? Balance sheet are avoided. So what I mean is banking, remember they have all kind of rate sensitive security or other security. Sometimes they wanted to remove out some assets to do the better favor assets. They swap out something they don't want it. Okay, that's what they do. Just like you don't want something swap out for something else you like it. So that's what it is. Pretty much like if you want to leasing out something, right? You swap out. Banking can free up their balance sheet because if I want something else, that's why they're doing that in the financial crisis during that period. Do the CDOs, they free up some balance sheet in order to do the CDOs. So now if we have new product, they do the same thing. They swap up something, then get some other instrument to make more money. So that's what sometimes banking doing that. Okay. So informational advantage maintained because what I mean, okay, once they swap it with a counterparty, you're going to monitor counterparty risk. So let's say you have a swaps, interest rate swap with, which let's say with GM, okay? Corporation also, they have their financial balance sheet. So they maybe do that with you. But then let's say you JP Morgan do the interest swap with GM. But then GM, you have other business with GM too. Let's say you have GM bond, whatever. So you want to monitoring GM, but then you have this counterparty risk. You already monitor GM already. So that's informationally take advantage of this monitoring GM, but meanwhile you have GM bond, GM swap, so you can maintain this information so you know their risk, non-risk. It's a better alternative, would say. Remember we said credit monitoring, moral hazard, you have to have the information. Now you have it because you have counterparty. So that's what something is better deal in that way. Now just hire people monitoring. Okay, so that's another way it's a good thing. But possible to hedge interest risk over very long horizon. So it means you can hedge interest risk. You had to know the interest rate direction, right? But still, you do this diversify a little bit, have something like you just got the LIBOR lag in and do something else. So floating rate net out, you can hedge it out. So many ways. Okay. So disadvantage. Swap market suffer from lack of liquidity. Remember about this before. It's agreement. So agreement always have a counterparty risk. So that means if before the counterparty risk, let me mention about liquidity. Remember, you had to find out you want the LIBOR. You had to looking for somebody who really exactly want the LIBOR to do swap. So you had to find a counterparty looking around. It's not like a future market. A future market is everybody trading there. So you see all the list of the price, all the list of product. But the swap, you had to looking for particular that counterparty who want to take your trade. Okay, so it's difficult. So that's why it's difficult liquidity. But when you close the position, you want to get out, maybe also difficult because you had to find exactly who is going to take over your position. That's the one thing is agreement is two party, therefore you have a liquidity problem. Okay. Second is definitely have a default risk because counterparty there, right? You're trading with the other guy, the other party. You just saw the banking, the other financial company. So that counterparty can just one single company. Who know this company is going to be good in the 5 years, in 10 years? You do not know. So if something wrong badly, this company will be default. So then you lose everything. Remember we said calculate the face value Everything's gone, face value is gone because the default. What do you mean default? Means the other party just file bankruptcy. Once they say bankruptcy means I don't pay you anymore. I'm default. I'm bankrupt. So that's the whole thing's gone, not just every periodic, the interest, the payment, whole principle is gone. That's risky, okay? And that's what the default risk. That's dangerous. That's why banking have the monitoring the counterparty risk and default risk, okay? The other one, so need for information, right? About the counterparties, like I say, you had to monitor them and thus attract intermediaries. So you need other third party doing the report, research, or alternative information. If investment banking follow their stock or their bond, then those information maybe come out, but you need somebody to give you information, right? So if you do the swap, normally like I say, is JP Morgan have the swap with this, let's say, with this GM, but also have GM's bond, had GM stock, hypothetically say they don't have GM stock, right? Because they don't allow to holding the stocks of another corporation. So then they monitor those bonds, then they have the swap. So that means they have to have the collect this information. So that means if you trade with them, you can monitor with them, like I said, counterparty risk. You have to monitor it, but at the same time, so you buy some of their bond monitoring at the same time. So take advantage of this information. Or you subscribe it, investment banking analyst report, right? Just they tap on GM stock movement or whatever, analysts downgrade, upgrade those corporations, they monitoring them. You can use those information too. But so definitely when you have this security, you will know how to monitor them, okay? So that's another way. So investment banking and large commercial bank can help them too, like JP Morgan, that's large commercial. Inside have investment banking, plus they do the trade as well. Okay, so many information you can get from there too, okay? Now they touch credit derivatives. Remember we mentioned about that, is the CDS is a credit default swap, okay? So credit derivative is similar like we have a credit option. It's option on top of those credit assets. For example, if underlying is the bond, the option on the bond, okay? And then so that's mean the credit options. So it means you have right to buy this bond, a right to sell in the bond, right? So that's what they do. Credit swap, I'm showing you credit swap with CDS, right? So then the credit default swap, see here, credit default swap. Credit default swap, you're supposed reading chapter 9, right? Remember chapter 9 is a financial crisis. And the chapter 9 is you're supposed to watch a movie and read the chapter, okay? So if you read it, you will know CDS. Okay, let's tell you credit default swap. All right. So same thing like before, you had party A, you had party B. Okay, this is important because this is the anomaly is happening. I said this Goldman Sachs. Okay, during the financial crisis, just like that. And then you have AIG. Oh, AIG. You know the financial crisis AIG story. Okay. So this is CDS, a credit default swap. Normally it's like this happen. Okay. So Goldman Sachs agree pay AIG certain things, and AIG agree to pay Goldman Sachs something, okay? So what's something? Here's something, okay? Let's say Goldman Sachs have MBS or CDOs. Let's say MBS, mortgage-backed security, right? We mentioned about this. So during the financial crisis all started, they know housing market tumble. So that's why MBS dropped the value. Okay, they know. So Goldman Sachs is worried. So therefore, Goldman Sachs said, okay, I want to go to CDS with my trading partner. That moment, the whole world, only one entity, which is AIG, trying to trading hedging for everybody else, okay? So what they did is like this. So Goldman Sachs agree, hypothetical, say pay 5%, okay, for 5 years, for example, just hypothetical for 5 years. It could be 10 years, could be 10%, either way. For 5 years, let's say the face value is just hypothetical, say 100 million, okay? So pay for 5, each year pay 5 million to AIG. Okay, so Goldman agree, AIG agree. So AIG will give it like this. AIG guarantee for MBS. Okay, so if MBS hypothetical, this MBS default, so then what happened? Then AIG will pay Goldman Sachs $100 million if default. So that means MBS is hedged. Okay, so if MBS collapse, right? So MBS default. Okay, so let me okay, now delete the other one. Let me erase the other one. Okay, so let me redo it. So AIG will say if MBS default, okay, so we'll pay 100 million. So that's what. So that's how the credit default swap, because this swap is on hedging on this MBS. When MBS value tumbling to the zero, okay, normally it won't be zero. You have recovery ratio, but forget it, just assuming the zero. So if a tumbling face value is 100 million, so AIG will guarantee 100 billion will give to you. So AIG betting on MBS won't have a default, won't default. So over this 5 years. But Goldman Sachs worry, so that's why Goldman Sachs hedged it. So willing to pay 5 million per year for 5 years, this is costly, but still Goldman Sachs wanted to protect MBS, right? They have it. So that's what a credit default swaps, all right? And that's what the AIG in the trouble. So during the financial crisis, why AIG, we pay out AIG, and that's why, because AIG do this with Goldman Sachs, with everybody else, with global, with French bank, they all do the same thing like this trade, okay? One direction, so they guarantee 100 million here, the other 100 million there, whole world. So at the end, AIG don't have that much money cover for everybody in the world. So that's why we pay out AIG. Payout means our taxpayers' money to pay out them. Why we pay out them? Because if we let AIG gone, if AIG default, everybody else suffer. The globally, a lot of banking suffer. So we have to protect the world. So have to pay out AIG. So therefore, your money, taxpayer money, give to AIG, immediate AIG money, give to global, every other banks, because they do this lag, this trade, this lag, they're hurting for everybody because this trade, okay? So that's what they did. They used the CDS credit default swap, all right? So the other one just linked to the another, security instrument, which is like the notes, the 10-year security notes that you're trading on. There's the same thing, like the logic of the credit default swap, that which is link which product, and then settle down agreement. So that's AIG. They mentioned what I just mentioned about this, but I assuming you're watching the tape and also read the chapter 9, because in exam, okay? So lesson from the global financial crisis. What are financial derivatives likely to be a worldwide time bomb, like we just had before, right? The credit derivative, it is the crazy one. It's just like that trade, AIG doing that, okay? So that moment is too much credit derivative. A lot of companies holding now that kind of trade, and cause big one direction. That's the problem, okay? So conclusion. So what's it mean? Tell you that derivative, it is good. Derivatives, for hedging. But remember, hedging, traders never sit down there just say, oh, I'm hedging, that's it. They are sit down there, do nothing. No, they kind of be play. So that's why sometimes they play in derivative. So derivative, it is risky, but a derivative is like this. If you just like tools, right? You use it, you know how to use it, you want it to hurt you, but you don't know how to use it, play around, it may be hurting you. So it's just like a derivative. It's supposed to design in the way is for protect us, but it end up could be hurting you badly. So that's why I'm trying to mention here, derivatives is risky because it's moving fast, all right? Because it's derivative on top of the asset moving slow, but then derivative moving very fast. So if everything moving fast is risky, right? You're driving car fast, it's risky. So therefore, the derivative is risky because they have something underneath there. And if the direction against you, hurting you, maybe it's okay. Normally market don't care hurting individual because you're betting on direction, wrong direction, just like a Bitcoin, right? People feel you want to make money, go ahead, buy, selling, it's okay. Make a lot of money, congratulations to you. You lose money, you want to, it's okay. But if becoming market, if a market in the trend go to one direction, hurting to mainstream, that's wrong. So that's why it is a derivative. If we're just serving that way, not serving for hedging, not serving for protect market, then become in trouble. Last time it's a derivative is a CDS get in trouble because didn't have centralized. Nobody regulate AIG because the AIG is supposed to be not financial company, not under like the Fed regulated on those commercial bank, investment banking, SEC regulate them. AIG is insurance company. So nobody care about AIG that much because insurance, insurance company is supposed to be very rich because think about it, AIG sit down there, do nothing, just collect your premium and say insurance for you if you have health, life, dental, or fire, flood, those kind of insurance. Those one is probability very low. They charge you, if you're in the flood zone, charge you a big premium. And maybe you never have fire, but you pay every year fire insurance. So they basically just collect the cash, right? Insurance very rare make money just like that. Nothing happened, it will be great. But they did this wrong bet on the financial product. It's just one department of AIG, but break it down the whole the company, okay? So that's because this is credit derivative, they're betting on the wrong direction. So that's why our regulation couldn't catch up because they're in the gray area. Nobody is responsible for insurance. Insurance should have a regulator, but regulator on insurance is not like a regulator on financial and banking. Financial and banking very, very tight on regulation. So nobody covered there. So that's why AIG take advantage of this moment. Nobody looking at them, so they just keep doing those business and then make trouble. But now, then later on say, okay, all the CDS become centralized. Everybody know net result is what, so becoming a little bit better. Each time we learn, right? Each time we learn from our mistake. So that's what it is, derivatives and useful, but dangerous and risky. So depending on how you're going to use it. But what the whole point about this piece is to tell you, say, okay, your regulator, remember we are the Fed. So we supposed to know have those product, have more, definitely. Each time you have a new innovation, right now Bitcoin, so many things there. So you needed to know when you are be the regulator and this whole things, okay? So this is the derivative. Let's say that I'm done. Any question? We good? Any questions? So we done. If no question, we done.
No questions.
Okay. So okay, good. So we done this chapter. Next one we'll go to the following chapter. Your exam going to be on May 20. I mentioned it before. Okay. So May 23, 30 p.m. So we will be waiting for closer. Then we'll make announcement on Blackboard. Otherwise, you'll be okay. All right. So good night, everybody. If you have questions, just ask me. Otherwise, we'll